Procida, chairman of William Procida Incorporated, along with Lee Munson, chief investment officer at Portfolio Asset Management. Gentlemen, nice to have you on the program. Welcome.
Good afternoon.
So let me begin with you, Lee. You're not so pessimistic as far as commercial real estate is concerned. Is that right?
Yeah, absolutely. I mean, we saw this summer that a lot of companies were able to do successful secondaries like Boston Properties. I think we're going to probably see some more secondaries, but I think that the Armageddon that we're afraid of in the banking industry is not going to happen in commercial real estate. So I would be looking to, pick up some of these names and get some value out of it while it's still cheap.
Bill, you're on the other side of that trade.
Well, I think in general, you got a lot of people doing a lot of financial engineering instead of working on their real estate. A lot of these big public companies, they're really not real estate folks. They're financial engineers, and that's how we got into this problem. The banks really were lending other people's money. We got a lot of mortgages coming due that were at 90% of inflated values. We've got corporate downsizing. So I don't think it takes a rocket scientist to figure out that next year when all these mortgages come due and the current, lending environment is not one that's going to take them out. And what's going to happen, in my opinion, is real estate's going to end up getting back into local entrepreneurs' hands who really know real estate, not financial engineers who got us into this mess.
Where specifically is the upset, Bill, in your view, and what kind of an impact are you expecting on the financial system in 2010?
Well, I think when you have, look, you take a couple of different things. You take all the job losses we've had. Well, that takes away space that's needed by corporate America. So who's going to fill that space? Now, small business and corporate America will eventually start hiring again, but in the short term, you've got a problem in that we just don't need as much space as we've built. Truly, the real thing that people should be focusing on that are in the real estate sector is work your real estate, work getting leases, work getting your expenses down, and don't spend all your time working on secondary offerings and all this other stuff.
Yeah,
I mean, it's all about real estate.
Bill, wouldn't you say, though, that, if we're going to have some type of recovery, even if it's a statistical recovery and there's no new jobs being created, the government has just forced us to have even larger banks. And we're seeing regional banks drop like flies. We might have a couple thousand banks.
Well, by the way, that's the problem. And I wrote an article years back, and it was very unpopular, saying real estate and banking will return to a local environment. I mean, nationalized banks, if you're in California, what do you know about making a loan on a piece of real estate in Wisconsin?
It doesn't matter because you've given Wall Street a toy and they're going to play with it. The government has given money to these large banks that they forced together, and they need to get that money in motion. Do you think it's more likely that they're going to loan money to an empty house in California or start loaning money to some sophisticated real estate operators in New York? They've got to get it moving, and I don't see it's going to be local.
But I don't disagree with you. They should be lending to sophisticated real estate operators. And in the next year, I think what we'll see is a shakeout between the real estate operators and the financial engineers who got into real estate after the RTC. And I think that the good news on this is it could be V-shaped, and it should be V-shaped because we have so much pent-up demand. The economy's been down so long. Corporate America did a lot of layoffs. I think that we're going to see a tough first half next year, but I think the smart folks, there's a lot of real estate money on the sidelines, and I think they're going to come into the game. They're going to get real estate cheap. It's not going to move up fast, but they're going to work it, and then I think we'll see an upside in the following year.
Bill, who's most impacted if, in fact, we were to see the commercial real estate market have a fallout next year? Where are the companies, and who, in your view, it gets impacted negative most?
Look at the regional REITs, not the national REITs. You take REITs that are just in a 3-4 state market. They can get to their property. They know if the elevator's out of order, it's really out of order, and that a property manager didn't just tell them that it was out of order.
And let me ask you, actually, Lee, because you're talking about looking at this as an opportunity. Let's say your scenario does play out, and in fact, you don't see such a big blow-up. Where are the opportunities? Tell me what you would be investing in then right now.
Well, I would start committing capital right now. I'd start scaling in. Now, because REITs are a relatively small part of the market, not a lot of people understand, only Simon Property Group, Vornado, those are large caps. Everything else is small. So I agree with Bill that we're going to have some blow-ups and we don't know where they are. I would stick with some of the indexes. VNQ, it's a Vanguard ETF. There's iShares has some ETFs in commercial real estate, IYR. I would start buying those names. You get a good yield. You don't have to worry about anything particularly blowing up. Now, if you want to trade them, I would look specifically at Simon Property Group, Vornado, because those have the size of Boston Properties. But outside of that, I think the average investor should go out there and start getting a position. Would you rather buy real estate and get rents and get paid, and know that these banks are going to lend with all the excess money that they have? Or do you want to buy some banks that some of them, like Citigroup, might be owned totally by the federal government? That stock could be at zero next year, and you're getting a penny dividend. I want to get paid while I wait, and if I want individual names, I'll stick with the top ones that are large cap.
All right, we've got both sides of the story here. Bill, Lee, great to have you on the program. We appreciate your time,
Always
gentlemen.
a pleasure.
Thank you very much. We appreciate it. We'll see you soon. Philadelphia Federal Reserve President Charles Plosser tells CNBC, meanwhile, that the Federal Reserve will have to consider raising interest rates as part of its exit strategy of unwinding the stimulus put in place during the financial crisis. Charles Plosser